I'm Michael Cochran with BentOak Capital, here to provide a brief market update for March 2024. Please make sure to watch till the end for an important disclosure statement. As we approach spring, temperatures are on the rise both in the weather and in the stock market. Since December 2023, the S&P 500 has shown remarkable resilience, with no pullbacks exceeding 2%. Historically, strong starts to the year often indicate further gains ahead, suggesting that this period of market calm may not necessarily precede a downturn. In fact, historical data indicates that when the S&P 500 has seen gains in January and February, it has typically resulted in an average gain of 11% for the rest of the year, with positive outcomes observed in 26 out of 28 cases. Furthermore, there's encouraging news regarding the market's response to the Fed's adjustment in interest rates. It appears that the market has largely adapted to the reduction in interest rate cuts from the Fed, with both the Fed and the bond markets generally in agreement regarding the trajectory of rates. While some upward pressure on yields may occur as discussions progress and certain inflation factors persist, the scope for significant increases in rates is limited given the anticipation of further rate cuts. The stability in interest rates can serve to support the elevated stock valuations and potentially reverse any losses experienced in the bond market earlier in the year. A strong fourth quarter earnings season has further bolstered stock valuations. Notably, the mega-cap technology companies stole the spotlight, with the top 6 technology firms contributing significantly to the S&P 500 earnings per share growth. This combined effort transformed a 4.5% decline into an impressive nearly 5% earnings increase, showcasing their substantial impact. Looking ahead, the outlook for earnings growth for the S&P 500 in the coming year has improved, contingent upon the U.S. economy achieving a smooth landing. Historically, stocks have demonstrated a robust track record of gains in the absence of a recession. Despite challenging circumstances, the Fed may have threaded the needle. Government spending initiatives have played a crucial role in supporting the economy, particularly as it progresses later in its cycle. Monitoring economic indicators, credit markets, and investor sentiment will be essential to detect any signs of decline. Encouragingly, a broader participation across the market extending beyond the top 10 companies represented in the S&P 500 would be advantageous. Combining technical analysis with fundamental factors will be particularly crucial in this context. Historical trends suggest that volatility may increase following a prolonged period of strong and steady market growth. While the S&P 500 has delivered an annualized return over 11% since 1980, it typically experiences a correction of 10% or more once a year, along with 3 pullbacks ranging from 5% to 10%. With a divisive presidential election approaching in just 8 months, geopolitical tensions, or weaknesses in mega-cap technology stocks. Here's hoping for a warm but not too hot spring for the economy and markets, keeping Fed rate cuts in play while providing a solid foundation for corporate America to grow earnings. That wraps up this month's video, but please visit the Resources tab on our website for several new blogs and be on the lookout for periodic updates through our social media channels. We continue our commitment to providing personalized service, and if you have any questions, please feel free to reach out to us.